let's get straight to the sell-off with our market panel. Joining us now, Kara Murphy from Kestra Investment Management, David Zervos from Jefferies, and senior economics reporter Steve Liesman. It is an all-star panel. I'm going to start with our guests here on set. David, I'll go to you first. Okay, soft jobs report, a lot of Fed speak today, some scuttlebutt that perhaps Waller is what spooked the market here. Your thoughts?
The data wasn't that bad. I almost think, we always talk about how bad data can engender a kind of good reaction in the market because then we get the faster rate cuts, but it wasn't good enough to get, or it wasn't bad enough to get us a good reaction, is sort of how I'm thinking about it. I think it's a 25 basis point move unless something really strange happens with the CPI, a big drop next week. Other than that, I don't think Waller really endorsed the 50. He said, I'll think about it. And the market kind of liked that for a little while and then didn't like it afterwards. But I just, it wasn't bad data. It was kind of mediocre data. And I almost think the market might have liked bad data better in a weird way to sort of say, OK, now we can get this going. Like, let's just get these rate cuts in the system and stop dilly-dallying because the Fed probably really shouldn't be at neutral here, or it should be at neutral. It shouldn't be 225 basis points above neutral.
Kara, your thoughts on this market here, especially as we have a very defensive tone to the market. Selling's been broad-based this week, led particularly by tech. But, for example, it looks like real estate basically ended the day flat today and is actually up on the week. And we also need to factor in the fact that we've got seasonality issues at play here, and you've got technical issues at play here with the S&P at its 50-day moving average.
So I think those are important things to keep in mind. So number one, we've been talking for a while about anticipating this being the season of volatility. September is the worst month of the year, typically, and then you layer in an election year, it tends to be even more volatile. We're also expecting a Fed pivot in a couple of weeks that also engenders a lot of uncertainty. So there are a lot of reasons why the market might be trying to find its way here. But then you layer in on top of that where we had pretty aggressive valuations on a broad basis, like throughout the S&P 500. So expectations had gotten quite high. I think the labor market today is telling us it's just right where it should be. It's softening, but that's okay. Not too much, not too little. The Fed's going to start cutting. So I think the economic environment, the fundamental environment is still very positive, but the market is trying to digest a lot in a short period of time.
Steve, as Kara just implied there, aside from the downward revisions in the jobs report, I didn't see any total narrative changers in there, even though the market is responding almost as if there were.
No, and I tried to add the jobs report to my list this week of the good, the bad, and the ugly when it came to data. And I didn't know where to put it, kind of echoing what Zervos was talking about. So I created a full screen where I put parts of the jobs report in different parts of my screen there. If you could call that up, guys, I'll show you. I had a weak beige book. I had a weak ADP. ISM manufacturing, which I don't care so much about anymore because it doesn't help me out. JOLTS was weak, construction spending. And then I put the payroll revisions in the weak part. And then I'll go through the strong stuff. Jobless claims, pretty good. Productivity could be a good untold story. Services was fine. Factory orders was strong. And then I put the payroll number and the unemployment rate both on the strong. So I divided it up, and I think it was mixed, and I think the idea that it was not definitive. You look at the 2-year trade early this morning. It went up, it went down. The market didn't know what to do with it. I think stocks proceeded to do what they were maybe going to do anyway. And I was just trying to figure something out, guys, which is whether or not there was much change at all in the Fed outlook. We went in with a slight bias to a quarter. We ended up with more of a bias toward a quarter when it comes to September, and certainly the idea that you're going to get to a 50 because I think the market is priced that way because they expect the economy to weaken. But I do not think that for a number that everybody was pinning their hopes on to go into the weekend with absolute clarity about the future, I think maybe we all should probably go for a drink.